Should I start a policy now because of the new 7702 change? The tax law that was passed at the end of December has some major impacts on cash value life insurance, or I should say, it was certainly hyped up to be major impacts on cash value life insurance. Here's how the big change with the 7702 law is going to impact cash value life insurance. MEC limits will be adjusted for the better. Guaranteed rates will also be adjusted. Whole life insurance products today and since the 1980s have had a guaranteed rate of 4%, with most companies, especially the top companies. So a minimum guaranteed interest rate of 4%. With this new change, once the new products are updated, the law was passed January 2021. It was snuck into a bill that was late December 2020, but the law has been passed. Companies are updating their products now. It's still going to take a couple months or several months before they're updated. But what will happen, the guaranteed rate is now 4%. It will be adjusted to be a range anywhere from 2 to 3.75%. So companies will have that choice to set their guarantees at 2% all the way up to 3.75%, but it's no longer 4%. So the question that we received is, hey, should I start a policy now because of these changes that are going to occur and the guaranteed rates can be slashed? Here's my answer. I wouldn't rush into it if you are uncertain about the product. The impact of this change will not be as dramatic as it has certainly been hyped up to be in the industry. Here's why. A guaranteed rate on a whole life insurance product is not the same as a guaranteed rate on a bank account or any other investment. For example, if you could put your money in a bank account and one was earning 4% and the other was earning 2%, which one are you going to choose? Duh, I'm going to pick the 4% one. Here's the thing. With a life insurance policy, there are other factors to consider. Insurance expenses, that's the big item there. Let me kind of prep this with a case study. So we recently had the privilege of putting a bank-owned life insurance policy in force between February and March of 2021. At this particular time, one of the insurance companies we were working with released their new product to comply with the new 7702 laws. So we got to look at the new product and compare it with the old product. The new product, based off the new 7702 laws, had a lower guaranteed rate than the old product. The deposit from the bank and the structure of this policy was identical with both products. Here was the difference. The new product, lower guaranteed rate, had stronger guaranteed cash values over time, but a drastically lesser death benefit in the year one. It was about 40 to 45% less in year one when they made that deposit. Over time, it did catch up, guaranteed and non-guaranteed. But with a laser focus on the cash value, if that's why I'm interested in cash value, lower guaranteed rate for the bank on the product, but the guaranteed values were stronger over time. Now again, if I compare this to anything else, I'm going to look at it and say, what on earth is going on here? How do I have a lower guaranteed rate but more money at the end of the day? The reason why, it partially has to do with that reduced death benefit I mentioned. Insurance expenses slashed. With the expenses being lower, that allowed the policy to move faster with much less drag. So, will retail products, what you and I can obtain, be different? Yes, but we're not going to see it drastically different. I would expect a lot of consistencies with that bank-owned life insurance product. That was from one of the 4 major mutual carriers. And just from the years of doing this, when we see how banks and BOLI products work, a lot of times ordinary retail products follow them in a lot of ways, from a design standpoint, cash value accumulation, all that good stuff. But should I get in now when I can lock in the stronger guaranteed rate of 4%? Well, if I like what I see now, it works, absolutely, can get in no problem. If I'm uncertain, if I'm still educating myself, I would not rush into it like I would not rush into it at any point in time. Now, if my question's on the flip side and I'm thinking, hey, what if it was better for the bank? What if it's better with the new product for me? Should I wait until the change occurs? Well, the good news is you do not have to wait either, because there's no solid estimated time frame as far as when the new products will come out. If I purchase an old product today in 2020, the new one comes out and it's much better, you will likely, with most carriers, have the option to update that to the new product. The same thing happened in January 2020 when the new mortality change occurred, new mortality table change occurred. Anyway, a lot of information there. The answer to the question is no, we should not rush into the old product now. There's no reason to do that unless we see it, we get it, we like to make decisions quickly. Nothing wrong with that at all. The big thing that I want to touch on here is if we are not ready to make a decision because we're still doing our due diligence, we haven't done enough research, we don't want to rush into it because that's where buyer's remorse pops up. When we buy something not fully aware of the features and benefits, expectations aren't set properly, it might work out, but it might not. So that's the kind of stuff we want to avoid so we don't have remorse and regret later. Anyway, I hope this helps. Reach out with any questions and we will talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.